Hello everyone, Luke McElfresh here. In today's video, we will be working through some practice problems from Chapter 12, which is titled Some Lessons from Capital Market History. So in this chapter, we talk about the correlation or the relationship between risk and return. So hopefully you understand that risk and return go hand in hand. The more risk that you take in a particular project or a particular investment, you would expect the greater return. So in this chapter, we talk about different types of return with nominal versus real returns, arithmetic versus geometric returns, and then we also talk about one of the main ways that risk is measured, which is calculating variance and also standard deviation. So when I look at this first problem, it says, suppose a stock has an initial price of $79 per share, paid a dividend of $1.45 per share, and had an ending share price of $88. What was the dividend yield, the capital gains yield, and the total percentage return? So we have some different types of return here that we're discussing when we are talking about stocks. The first would be the dividend yield. So hopefully you realize that the dividend yield is simply the next year's dividend divided by the current price. So what type of yield or what type of return are you receiving in the form of a dividend? So in this problem, they say that the share will pay a $1.45 dividend per share, and the initial price was $79. When I divide those two values, I get a value of 0.0184 or a 1.84% dividend yield. The other type of yield that they ask for is the capital gains yield. So capital gain would be the increase in the value of our asset. So to calculate the capital gains yield, we simply want to know how much did my asset, in this case a stock, how much did this stock increase from this one period to the next. So the ending share price is $88, the beginning share price of $79. We subtract those to see that we had a $9 increase, and we would divide it by the beginning amount of $79 to get a capital gains yield of 0.1139 or 11.39%. And then your total percentage return is just the sum of the dividend yield plus the capital gains yield. So to solve for the total percentage return, it would be the 1.84% dividend yield plus the 11.39% capital gains yield for a total return of 13.23%. So hopefully you realize that to calculate your total percentage return, you could also just identify what the total income would be from that particular investment. In this case, we have a $1.45 dividend plus a $9 increase in share price. If we were to take $10.45 and divide it by our initial value of 79, we would have gotten that same total percentage return of 13.23%. So now for this second part, they want to know what is the dividend yield, capital gains yield, and total percentage return if the ending share price actually decreased now to $71. So in this case, we actually experienced a capital loss. The dividend yield would still be the same. It's still a $1.45 dividend divided by the initial price of $79. So we still get that 0.0184 or 1.84%. Now our capital gains yield will actually be a negative value. So it would be the ending price of $71 minus the beginning price divided by the beginning price. It was a decrease of $8 on our initial investment of $79. So in this case, we would actually have a negative capital gains yield. In this case, we say we have a capital loss. So it would be a negative 10.13%. So your total percentage return, once again, is your dividend yield plus your capital gains yield, which in this case is a negative. So your total percentage return here would be a negative 8.29%. So this first problem just dealt specifically with calculating a percentage return, breaking down the percentage return on a stock into the two components, which are a dividend yield and also a capital gains yield. And so that's one way that we can calculate the return on an investment, and that one way would be a percentage return, and that's what we did in that first problem. Number two, suppose you bought a bond with an annual coupon of 7% 1 year ago for $970. The bond now sells for $940. $1,000 face value. What was your total dollar return on this investment? So again, we are going to be calculating a return for this asset. In the previous problem, we dealt with an investment where we were dealing with a stock. In this problem, we are dealing with a bond. So for part A, we first want to know what our total dollar return is. If it is a 7% coupon, that means 7% of $1,000 par value would be our coupon amount. So to calculate the total dollar return, it's going to be the coupon amount plus any change in the pricing of the bond. So our total dollar return would be the sum of those two cash flow streams. The 7% of 1,000 would be a $70 coupon, plus what type of increase did we have on our bond. In this case, the price now is $940, and we bought it for $970, so it actually decreased by $30. Our total dollar return then would be $40. Then it says, what is your total nominal rate of return? So nominal just means of name only, so it has not been adjusted for inflation. Similar to the last problem, if I want to calculate a rate of return on an investment, it is simply the cash income, so the total dollar return divided by my initial investment. So $40 total dollar return divided by my initial investment of $970. My total nominal rate of return would be 0.0412 or 4.12%. Same exact kind of thought process as in the first problem. The first problem was dealing with a stock. Second problem is dealing with a bond. When you want to calculate your percentage return, it is the cash income from that investment. In the first one, it was a stock, so it was dividends and then capital gains. In the second one, it was bonds, so we're dealing with coupons and any capital gain or capital loss. But those concepts are the same whether or not you're evaluating a return on a share of stock or on a bond. Now, Part C is a little bit different, where now they want us to know if the inflation rate was 3%, what would be your total real rate of return? So your real rate of return is the rate of return that takes into consideration inflation. Nominal is it has not been adjusted for inflation. Real has been adjusted for inflation. So what they're asking us to use here is the Fisher equation. The Fisher equation says that you take 1 plus your nominal rate, and it is equal to 1 plus your real rate times 1 plus the rate of inflation. So this is an equation that relates the nominal rate, the real rate, and whatever inflation would be. So in this problem, we have 1 plus our nominal rate, which is 0.0412. That's what we solved for in Part B. We are solving for our real rate, and the rate of inflation is 3%. So as we go through with our calculations, you would isolate R, and you would see R is equal to 1.0412 divided by 1.03 minus 1, and then you end up getting a real rate of return of 0.0109 or 1.09%. So that was the first part of the problem, or the first part of the chapter, which was being able to calculate a return. We know how to calculate a dollar return and also now a percentage return. When we first calculated our percentage return, we then took that one step further and we were able to calculate the real return, which is the rate of return that takes into consideration inflation. So now let's look at number 3. So we've observed the following returns on this stock. So we have our percentage returns over the past 5 years, and they want to know what is the arithmetic average and what is the variance and the standard deviation. So the arithmetic average is just your simple average. To calculate your simple average, you are simply going to take all of the returns and divide them by the number of returns that we have. So we have a 7% return plus a negative 13% return, plus a 21% return, plus a 34% return, and a 15% return. Notice that I have these in decimal form. I have 5 returns dividing by 5. So on average, this stock provided a simple return of 12.80%. So now to calculate the variance, our next step is to calculate the variance, and we need to utilize the variance equation, which says that we take 1 divided by n minus 1, and we multiply it by the sum of the squared deviations from the mean. So to calculate the variance here, our equation says it's going to be 1 divided by n minus 1 or t minus 1. So in this case, it's going to be 5 minus 1. And then we are going to multiply this by the sum of the squared deviations from the mean. So in year 1, we had a 7% return. The difference between the mean of 12.8%, and we square this value, and then we're going to add this, and we're going to do this each year over the course of this 5-year investment. So the next year's return is a negative 13% minus the average of 0.1280, we square it. Same thing with the third year, 0.21, 21% minus 0.1280, we square it. Add to it the next year's, which is 0.34, minus the average squared, and then we have one more, which is 15% minus 0.1280 squared, and this whole thing will be multiplied by that 1 divided by n minus 1. So I realize that's kind of hard to visually see as I'm writing here, but the variance is the sum of the squared deviations from the mean, meaning that we are just subtracting that year's minus the average over the course of that 5-year investment in this particular problem. So when I go ahead and do these calculations, I end up getting a variance of 0.03052. Now this value alone will just showcase to you exactly what we're saying there. It's the sum of the square deviations from the mean. The standard deviation then is the square root of that. So the square root of 0.03052 is our standard deviation, which in this case is 0.1747 or 17.47%. And then in this chapter, you'll notice how they talk about standard deviation and how we can utilize that to predict what the next year's or what the return values kind of fall within if we have normal distribution. But standard deviation is a very common measure as to the volatility of a particular return or the volatility of inputs that are used in some data set. So that was taking some returns, first calculating the average, and then being able to take that average to calculate the variance. This is called sample variance, and that's why we have this 1 divided by n minus 1 portion of the equation. This will give us an unbiased sample variance. There's additional information on sample variance versus population variance if that is something that interests you. For our purposes, we don't go into detail on that. But then once we calculate the variance, we can then calculate the standard deviation by taking the square root of that value. So let's continue on and take a look at number 4. So here in number 4, it says that we bought one of Matt Ryan Company's 6.5% coupon bonds 1 year ago for $1,090. These bonds make annual payments and mature 14 years from now. Suppose you decide to sell your bonds today when the required return on the bonds is 5.2%, inflation is 3.9%. What was your total real return on your investment? So this is the same thing as what we did in number 2, where we are calculating the return on an investment, which would be the coupons plus any capital gain or loss divided by the initial price. So the first thing that we need to identify is we bought the bonds 1 year ago for $1,090. In order to identify what the capital gain or loss is, we first need to be able to calculate what the current price is. What is the current price to identify whether or not we have experienced a capital gain or a capital loss in this scenario? So this takes us back to our bond valuation chapter, where we are solving for the price of a bond. We know what the future value is, that's our par value. We have our payment, which is our coupons, your N and your IY. In these are all annual payments, so these are all going to be input in on an annual basis. Since it is 6.5% coupon bonds, that's 6.5% of 1,000, so the coupons would be $65. They mature 14 years from now, so there's 14 payments remaining, so that's going to be our N. It says that the required return on bonds today is 5.2%. That's your yield to maturity, the going rate out in the market for bonds of similar risk. So 5.2 is our discount rate, our IY. Future value is the $1,000 par value amount, and I'm solving for the present value. When I solve for the present value, I get a price of $1,127. I'm going to just take this to 4 decimals since it's an intermediate calculation of 0.0525. So going back to the initial question that is asking, what is your total real return on this investment? In order to calculate the real return, we first need to know what the nominal return is. So our nominal return is identifying what is our total cash income over this period, and we divide it by the initial price. So using this equation here, we know that the initial price is $1,090. That's the initial amount that I paid for the bond 1 year ago. Over the course of this 1 year, I've received a $65 coupon. And now I need to see if I have a capital gain or a capital loss. So in this case, I bought it for $1,090. It is now $1,127, so I've experienced a capital gain. Let's identify what that amount would be. So to identify how much it went up, we take what the current price is minus what I paid for it. And when I go ahead and calculate this total this nominal rate of return, so this is our nominal rate of return, so it has not been adjusted, we would end up getting a value of 0.0936 or 9.36%. So that is the percentage rate of return on this investment, which is again just our total dollar income divided by our initial investment. Now that doesn't exactly answer our question. The last part of this question says, what is the total real return? To calculate a real return, that is your return that has been adjusted for inflation. So we have to use the Fisher equation, which is 1 plus your nominal equals 1 plus your real times 1 plus your rate of inflation. We just solved for this nominal rate of 9.36%. We are solving for the real rate, and we know that the rate of inflation was given of 3.9%. So then when I go ahead and solve for R, isolating R, I would have 1.0936 divided by 1.039 and then minus 1 from all of this, and I would get a real return, the rate that has been adjusted for inflation, of 0.0526 or 5.26%. So once again, we were solving for a percent return. This one just required us to go one step further and first calculate the current price to identify whether or not we received a capital gain or a capital loss. But it's the same concepts as numbers 1 and 2, in particular the same type of setup as number 2, identifying what is your total dollar return, in this case the coupon plus the capital gain. We divide it by our initial price to get our total percentage return, and then we plug that into the Fisher equation to solve for the real return, which is the rate of return that takes into consideration inflation. And then, so for this fifth problem, they're asking for the arithmetic and the geometric returns for these stocks. These are just two different ways that you can calculate an average return. The arithmetic average return is a simple return, so it is the return earned in an average year over a multi-year period, whereas your geometric return is your average compound return earned per year over a multi-year period. So your geometric return takes into consideration compounding. The arithmetic return is the one that you're most familiar with. So to calculate an arithmetic return is just simply the sum of the different inputs divided by the number of inputs that you have. So in this case, it is 0.09 plus 0.21 plus 0.32 plus a negative 0.18 plus 0.27. I like to be consistent, so I do go ahead and adjust all my percentage into decimal form before I plug them into my equation. You do get the same answer if you use the actual percent form. And I'm going to now divide this. Oh, I'm missing one input, a negative 12%. I'm now going to divide this by 6. I add up each year's return, divide by my total number. I get 0.0983 or 9.83%. So that is the return earned in an average year over a multi-year period. It's just your simple average. Now the geometric return, like I stated earlier, is the rate of return that takes into consideration compounding. So it is your average compound return earned per year over a multi-year period, and it will always be less than your arithmetic average return if your returns have any variation. So I should expect to get a value that is less than 9.83% because it is considering the fact that after that first year I get a 9% return and then I'm compounding whatever my starting point was and earning another 21% that year and so forth. So the equation for your geometric return said you take 1 plus whatever the return is, and you're going to multiply this for each year. So in this case, we would do this for however many years of returns that we have. We take this entire product and we raise it to the 1 over t power, where t is the number of inputs. In our case, it's going to be 6, and then we subtract 1 from the whole thing. So plugging in our inputs, we have 1 plus 9% return, multiplied by 1 plus 0.21, a 21% return, multiplied by 1 plus 0.32, a 32% return, multiplied by 1 plus a negative 18% return, multiplied by 1 plus 0.27 return, multiplied by 1 plus a negative 12% return. We're going to take this product, we multiply it to 1 over t, where t is 6 because we have 6 years of returns, and then we subtract 1. So when I do these calculations and my final output ends up being 0.0810 or 8.10%. That is the geometric return. That is the average compound return that I earned per year over this 6-year period. So kind of just like we thought, it is less than our arithmetic, our simple average return. But those are two different ways that you can calculate the average return over a particular time period. So as we've kind of showcased in these practice problems, Chapter 12 does deal with returns and risk. We do understand that the more risk you take in a particular investment, you should be compensated for that risk, so you should have a higher return. This chapter kind of outlines some of the historic returns that different investment classes have provided based on the different risk levels. How do I measure risk? I measure risk through variance and standard deviation. Variance being the sum of the square deviations from the mean, standard deviation being the square root of variance, very useful if we have normal distribution. And then we also talked about the different ways that you can calculate a return: percentage return, dollar return, arithmetic return, geometric return. So I hope this helps in your completion of the Chapter 12 homework and quiz assignments. As always, if you have any questions, please don't hesitate to contact me, and I will talk to you all soon.